going to cover as many as I possibly can. Now, a few things that, by the way, Dawn, thank you very much. Let's hear it for Dawn. All right, thank you, Dawn. All right. Yeah, let's go grab that. No, that's okay. I got it from here. Okay, great stuff. Thanks, Dawn. Now, there are a few things that I want everyone to understand that I think are absolutely crucial to every single investor in the room. And one of those is the concept of what I refer to as don't get caught in the system. Don't get caught in the system. And this is the wisdom part of today. You see, the majority of Canadians and Americans spend over 100% of what they make. And that is absolutely fantastic for the economy, because consumer spending is the major force that drives economic growth, Canada, the United States, worldwide. And what happens is the system loves you to spend a lot of money. However, what's good for the system is not necessarily good for you. And that's what I mean by don't get caught in the system. Another great example of not getting caught in the system is the majority of people, let's just get a show of hands. Who buys mutual funds in the room? Who buys mutual funds? Okay? Now, this is something club members have seen me talk about. I'm the chairman and CEO of the Freedom Investment Club, and I think I should tell you offhand just one little thing about the club, so you're aware of who I am in the background. Right now, I oversee $120 million of assets, and that constitutes close to 6,000 members. Many of them are former MMI graduates. Now, our internal rate of return, when you factor in gains, realized and unrealized gains, a $10,000 investment a little over 4 years ago is now worth $33,000. That is a gain of close to 40% per annum. Okay, who would like to be able to get those type of returns? All right. And what happens is month after month after month, I'm on a call every single month, a conference call with thousands of people, and I talk about what's going on in the world, what's happening in the economy based on what's going on in the world, what's happening in the economy, how you can get the highest return on your investments. Now, I realize as well, and I want to get an idea in the room, and this will also help me to gauge the talk today. So I want to use a scale of 1 to 10. So 1, 2, 3 is you're afraid to open up the financial papers because you don't understand any of the words in there. It scares you. 4, 5, and 6 is you're in a position, you open the papers, you read a little bit, you have a broker account, but the majority of everything is done by the advice of your broker. You have very little input. 7 and 8 is you have your own accounts, you do some of your own independent trading, and you feel reasonably confident with your investing. And 9 and 10 is you're a pro, you're licensed. So let me just get an idea of who's in the room right now. If you feel you're in that 1, 2, 3 category, raise your hand. Okay. If you're in the 4, 5, 6, raise your hand. Fantastic. If you're in the 7, 8, raise your hand. All right. And if you're in the 9 or 10 category, raise your hand. All right. So we've got a broad spectrum. And I realize that there's nothing worse than going to a conference, and you're at a conference, and the gentleman on stage has his PhD in economics, and he talks to you like you got your PhD in economics. So what I will do is, whether you're an absolute newbie and you're in that 1, 2, 3 scale, or you're on the other extreme and you're a 10, and I know you're all 10s, but just on the example I gave, what I will make sure is that you walk away with value, things to think about, and things that basically at the end, my objective and my goal up here, and the one speaker who I get to watch was quite a bit was Mr. Silver. I totally agree. It's about taking action. And what I hope to do is to explain and show you some things that are going on that allows you to take some action steps for yourself, to make money for yourself, or to prevent you from losing money. So let me just show you this to begin with, because I did ask how many of you had mutual funds, and I just want to give you a couple of quick things that you can take home. Now, if you invested $10,000 into what's referred to as the S&P 500, the S&P 500 is 500 of America's largest companies. And the average rate of return over the last 50 years has been 10%. And if you put that $10,000 in for 50 years, you would end up with $1,170,000. For many of you in the room, that's certainly enough money to retire comfortably. However, there's something called a management expense ratio. Now, close your eyes. Everyone in the room, close your eyes. Close your eyes. Close your eyes. I know you're walking in the back, sir, but close your eyes. Okay? Close your eyes. All right, raise your hand if you do not know what is a management expense ratio. Raise your hands. Raise them. Raise them nice and high. Higher, higher, higher. Raise both hands in the air. Both hands in the air. Both hands in the air. All right. Now wiggle them a little bit. Wiggle them back and forth. Wiggle them back and forth. Now open your eyes and look around. Open your eyes and look around. Okay? Put them down. Put them down. Senior, you're proud to be beside them. Give them a high five and say, thank you for participating.
Thank you for participating.
Okay. Now, what happens is, with only a 2% management fee, what the management expense ratio is the fee that your financial advisor or representative takes on a yearly basis to manage your money for you. That's what it is. So a 2% fee over that period of time, you would end up with only $470,000. Your opportunity cost of managed money, ladies and gentlemen, Kevin, where are you? Would be $700,000. That's the damage of managed money. That's the damaged money. What I'm trying to do is take something that sometimes I talk 3 hours on and condense it into just about 5 minutes. But there's some things, because I saw so many people owning mutual funds, and I have a responsibility up here to educate you. So I'm just going to show you one, and this will hit home, and probably it's a great one for you to show your family and friends. From 1980 to 1985, there was a chimpanzee, and the chimpanzee's name was Harry. Harry had a wall in front of him of 500 of America's largest companies. And what Harry did is he walked up, and there were 30 stickers on a table. 30 stickers on a table. He picked up a sticker. He went up to the wall, and he put a red sticker on one of these companies. He then went back to the table. He picked up another red sticker. He came back to the wall. He put another red sticker on one of the 500 companies. He came back. He grabbed another sticker. He went back to the wall. Harry did that 30 times. Each year, what they did is they took Harry's 30 picks, and they measured them against all of the mutual funds in Canada and the United States. Wealth and wisdom attendees. Harry outperformed 85% of all of the actively managed mutual funds in North America. Scary stuff. Who thinks that's scary?